Good day, students, once again. Today's focus video will be on the chapter 7 to those who are using chapter 7 of the book that I sometimes record in the Cost and Management Accounting book used by the Universities of Technology. It is Cost Volume Profit Analysis, abbreviation CVP. And I think probably this will be the last or second last video on this topic, because I already have other videos that have covered some of the dynamics that are covered here. Now it says Shux Ltd purchases and sells or sell a single product, and we are provided with the information below, which is available by the end of September 2011. Which is the year the information is provided for. We are given the selling price of this single product, and the selling price of this single product is given to us as 75 Rand, and we are given the manufacturing costs per unit, and the total of our manufacturing cost per unit, it is 45 Rand, made of 20 Rand plus 15 Rand plus 10 Rand of the direct material, direct labor. And we know that material and labor are called prime cost. Just to remind you of that, direct cost are prime cost. Then we have direct labor and manufacturing overheads, only those that are variable in this case. And we know that direct material and manufacturing overheads are called conversion cost, not only variable. All the manufacturing overheads, both fixed and variable, they are conversion cost. Then we have the total of these three, which is 45 Rand. Then after, we are provided with the fixed manufacturing factory overheads as a total amount, meaning now all these costs were the cost per unit, and you can see the amounts are very small. And obviously the selling price per unit, not the total sales revenue. Then we have the fixed manufacturing cost or factory cost as a total of 465,000. We also do have the variable. I want to highlight the fact that this is a variable cost. Remember, these manufacturing costs, they were all variable, because we know that material is a variable cost, labor is a variable cost, and factory overhead is specified to be a variable cost. So now we're also seeing that there is another variable cost, which is a non-factory cost, meaning a non-manufacturing cost or a non-production cost. And this cost is variable, and it is 5 Rand per unit. And I always highlight the fact that selling costs, they normally vary with the number of units that are sold, because it is the cost that we incur to sell a product. So now it is not based normally on the number of units manufactured, but it's normally based on the number of units that are sold. So hence the selling cost will always be calculated from the units that are being sold or that have been sold. Now we have fixed selling and administration cost, which is also in total 195,000. And you can see that the costs that are fixed are given in total. Obviously, the reason for that is because when we are calculating our break-even point, because chapter 7 is normally on the break-even point, margin of safety, percentage, or units. Now normally we will need to calculate what we call break-even point, meaning the number of units that are sold in order for the company to get a zero profit, meaning no profit. The total sales revenue equals to the total expenses, variable and fixed expenses. Now that is why normal office cost will be in total, but they can also be given per unit on condition that we are given the number of units that are budgeted. Now that is very well clearly set. Then we are provided with the requirements below, and our requirements are read as follows. First, there's a note that says all calculation to 2 decimal places and nearest rands Now that is very important, and to highlight that 2 decimal places and to the nearest rands, but that is not much a transmesh. And nearest rands, I think this must have been should be just 2 decimal places or nearest rands, but it will depend to the information that we are provided. Then we says calculate the break-even point in units and in sales value. Now we are required to calculate our break-even point, and we know that to calculate our break-even point, we say that break-even point, I'll just use the abbreviation, it is fixed cost, meaning total fixed cost. I want to say plus so that when I reach there we are not confused. Plus required profit, meaning if there is a profit that we require to get, then now we need to add this fixed cost plus a required profit, divide this by contribution per unit, divide this by our contribution per unit. So now this is the formula on how to calculate the break-even units, meaning the number of units that the company needs to sell in order for it to reach at the break-even point, meaning where the company does not make a profit and neither a loss, meaning the total sales revenue is equal to the total expenses. Now on that same note, then we go now and check if do we have enough figures for what we are doing. Now we have to look at the total fixed cost, meaning fixed cost. In this case, we are not told how much is the required profit. Remember, required profit can also be required return on investment. They normally say required return on investment, meaning how much does the owner wants to get as the return out of the investment that he put into the business. And sometimes when it comes to the required return on the investment or expected return, they'll give you how much the owner has invested, and they'll say maybe the owner wants to get a return of 10% or 25%. Some of the video that I did before on CVP, I did highlight that. Now we are told to take into account fixed cost. And I want to highlight the fact that when we say fixed cost, we are really referring to fixed cost. Whatever is fixed must be taken into account. We have fixed manufacturing cost of 465,000. We also have fixed selling cost of how much? 195,000. We add both of them because these are fixed costs that don't change because of the level of activity. Then it will be 465,000 rands plus 195,000 rands, and this gives us 660,000 rands. We are not told of how much is the owner wanting to get the return on this investment. So now that means we'll have 465,000 rands plus 195,000 rands. Then we divide. Do we know the contribution per unit? We don't know the contribution per unit yet. So that means we need to calculate the contribution per unit. So now let us do the calculation of the contribution per unit. How to calculate the contribution per unit? Then now to calculate the contribution per unit, we say selling price. We say selling price, and if my memory still serves me, selling price was given to us as 75 rand, and there is correct, our selling price is 75 rand per unit. Then we say selling price minus variable cost, Remember, when you say variable cost, we are referring to everything that is variable, everything that is variable production and variable non-production cost. All of them together, we need them there. So now, first of all, we know that under variable cost, we'll have direct material, which is a variable cost, 20 rand per unit. Then after we have our direct labor, which if my memory still serves me, it was 15 rand. Yes, there 15 rand, and variable manufacturing overheads of 10 rand. Then after we have manufacturing overheads that are variable of 10 rand, and we record that 10 rand. Then after there was selling and admin, selling plus admin, that was variable. We are only looking for all the variable cost in order for us to get to what we call contribution per unit. Our variable selling and administration cost or expense per unit was 5 rand. So now we record this 5 rand, which is a variable cost. So now we know that the total of these three, it was 45 rand, then plus this 5 rand, definitely it will be a sum of the variable cost per unit amounting to 50 rand. 50 rands, let us check if this is really 50 rands. We have 20 plus 15 plus 10 plus 5. Yes, we have our variable cost as 50 rands per unit, and you can put brackets, but that minus indicated that these amounts should be negative. But I prefer sometimes to put all these brackets in each and every figure, because some lecturers can sometimes be difficult. Now we will get to what we call contribution per unit. Contribution per unit. And our contribution per unit will be 25 rand. Remember, contribution, it is the amount that is used to cover fixed cost. I want to repeat this one. It is the amount that we use to cover fixed cost. Remember, when we sell our product, we sell it at 75 rand. Then after we say we need to minus all the cost that we have incurred to produce this product and to sell it. So after we have deducted all these expenses and only the variable ones, then we get to what we cannot call a profit, because there is still fixed costs that are not yet taken into account. So now, in other words, the fixed cost of 660,000 is the one that is being contributed by 25 rand, if I am making sense. In other words, that means now for every unit that we sell, this 25 rand will be reducing our fixed cost. That is why it's called contribution per unit, the amount that will contribute to cover fixed cost. Then now immediately when the total contribution is equal to the fixed cost, we are at the break-even point. Let me repeat that one. When the total contribution is equal to fixed cost, then we are at the break-even point. That is why when we're calculating our break-even point, we say fixed cost divided by the contribution per unit. Now, in other words, for every unit that we sell, we are going to say how much the contribution. Our contribution, it is 25 rand. Then out of that 660,000, we say minus 25 rand. Then now we see how much is left of our fixed cost. Then we say 660,000 minus 25 rand. How much do we get? 559,000 or 659,975. This is one unit that we have sold. Then on the same day, or after 5 minutes or 10 minutes or an hour, depending to what kind of business we are, meaning how frequently our sales are happening, then the minute we sell a second product, then we say when we sell the second product, we are going to sell it at the same 75 rand, and we expect to incur obviously the same variable cost that we have already incurred. Then we say again there will be another contribution per unit of 25 rand. We take that contribution, we say it is meant to contribute in covering our fixed cost. Then we say in our fixed cost minus another 25 rand. Now we can see that our fixed cost will decrease now again by another 25 rand of the second unit that we sell, meaning 659,950. Then again we sell a third product. This was second. We sell a third product, we get another contribution of 25 rand. Again now we do the same thing. We say this minus 25 rand, we get to another contribution of 659,925. Now this is what contribution means. A contribution, it is the amount of the portion of the profit that is used, or is the portion of the sales that is used to cover fixed cost, because we sold our inventory at 75 rand and we covered our variable cost already, and there's still a marginal profit there, which is not a real profit. So we say now, out of our sales, how much will cover our fixed cost after variable costs have been taken into account? That is what we call contribution per unit. That is why now I'm saying to you, immediately when this total contribution equals to our fixed cost, meaning equal to that 660,000, we are at the break-even point. And now I'm rushing to other thing that I should not be rushing to, but this is very important to understand the contribution. What does it mean when you say contribution per unit? What are we contributing to what? Now, I hope I made myself quite clear on that. So now we do have our contribution as 25 rand. So now we can calculate our break-even point. Then now our break-even point, our break-even point in units, we know that it will be total fixed cost divided by contribution per unit. And our total fixed cost, it is 660,000 rands divided by our contribution per unit of 25 rand per unit. Therefore, now the units that we need to sell in order for us to be at the break-even point, it is a total of 26,400 units. This is the number of units that we need to sell in order for us to be at the break-even point. That means in order for us to have a profit that is equal to our expenses, that is at the point where there's no profit or there's no loss. They normally call it, I think in economics, a national profit, which is a zero profit, because there is a profit, because zero is a number, it's not a negative amount. Then now if we sell this 26,400 units, how much will be their value? Therefore now we say, how much are we selling them at? We sell them at 75 rand. Therefore now our break-even point, this was in units, this is in value. Please write all the details, don't use abbreviation for abbreviation that are not acceptable, because BEP is not very much acceptable. CVP, that is not a problem. So now meaning our value of sales in terms of the amount, it will be multiplied this by 75. It means the company will have 1,980,000 as the revenue from the sale of the 26,400 units at a selling price of 75 rand per unit, in order for them to be at the break-even point. So now this will be the sales value, or the break-even units, the break-even value, and this will be the break-even units. So now we have covered that question in both of its dimension. Now, what else do I need to explain? Okay, that is enough so far. I was just thinking of another angle that I wanted to touch base on. Now we go to the next requirement. The next requirement says we must calculate the number of units that must be sold in order to generate the net income. Take note of that. In order to generate the net income of 150,000. This is the required return on the investment, or the expected return on the investment, meaning the owner is saying, I have invested some money in this business in order to produce these goods and services and sell them. And to how much I've invested, I need to make sure that I get a return of 150,000 rands after I have covered all the expenses for the operation of this business. So now this is the required, or the return, or the expected return on the investment by the owner who has invested in this business, or by the investor. Now that means it comes back now to the formula that I brought to you before, where I said that in calculating the break-even point in units, we need to say fixed cost plus net profit or required return on the investment, net income or net profit. Now the owner in this case is looking at the net profit of 150,000. Then we don't forget to divide this by our contribution per unit. We know that our fixed cost remained the same at 660,000 plus the expected profit by the owner of 150,000. Then we divide all of this by the contribution of 25 rand that we know, and have already calculated that as contribution in the previous question, because there was no change either on the selling price or on our variable cost. Then now we show the calculations of that, and we say 660,000 rands plus 150,000 rands, we get to an amount of 810,000 rands, which must be divided by our contribution of 25 rands. Then now we say divide this by our contribution of 25 rands, meaning the company must sell 32,400 units in order for the owner to make a profit for himself of 150,000, meaning a return of the owner of 150,000 rands. Meaning now, if you know, or if let us say you have invested money and you know how much you need as a return out of what you've invested, meaning how much do you get as a profit for yourself in this business at the end of the month or end of the week, then you say, okay, I want 25,000 from this business given back to me from what I've invested. Then now you can work from that in order for you to determine how many units must be sold so that you can get the required return that you need. Or at the same time, you can work backwards, calculating how much can be the selling price, considering the given variable cost or cost that you already have. Yeah, but I don't want to go to the details. It's a very exciting exercise to work that one backwards, and it's very practical and very useful in the business world. Before you venture into any business, look at the profitability and the break-even point and the expected return, and make sure that you reach that target. Now, that means now if the company is selling 32,400 units instead of the break-even point of 26,400, the owner will get a return of how much? Of 150,000. What does this mean? That means now we can strike the difference between the two, and we verify this 150,000, if is it really a possible thing for us to get the 150,000. Now, if the company sells 32,400 units, which is the required units for the owner to get 150,000, and the break-even point units is 26,400, meaning the difference from the break-even point to the required units of the required return on the investment will be total units of 6,000, meaning we say 32,400 minus 26,400, and we discover that the difference or the units must be 6,000 above the break-even point units. Now we say, okay, how much is the contribution for this company, which is 25 rand. So now if you say this by 25 rand, we can say that the owner will really get the profit of 150,000 rands. Remember, the fixed cost, I want to highlight this, the fixed cost have already been taken into account at the break-even point units. Meaning, when the company managed to manufacture the 26,400 units, that means the fixed costs were already covered by the contribution per unit. That is why now I'm taking only the 25 rand, because the fixed costs are already covered. So now whatever the owner is making now after this 26,400 units, whatever the owner is making, that will be contributing to the profit that he expects to get out of this business. Now, let me hold my horses there and don't explain too much sometimes. Now, we have covered the second part of the question, and 3.3 is telling us that we must calculate the margin of safety ratio if the current sales equal to 2,200,000 and explain your answer to show your understanding of this question. This explanation, it is very crucial, if not very important. Now, we are now required to calculate the margin of safety. Look at this word, safety, meaning we want to know our safety position. Now, safety position in what? Let us go and calculate our margin of safety. Now we are here calculating the margin of safety, which is requirement 3.3. Normally I don't write numbers all the time. Now we have the margin of safety, and it must be a ratio. It is our current sales minus our break-even point sales divided by our current sales. Please know your formulas, guys. Formulas is just something you need to memorize. Our current or expected sales are 2,200,000 rands, and our sales at the break-even point. Our sales, remember, we are given the revenue in this case. We are given sales of 2.2 million as the revenue, not expected sales as the number of units. So now if this is in rand, this amount must be in rand, and the one that we divide must also be in rand. So please be consistent when it comes to that. Now we have our sales income at the break-even point, meaning break-even point sales value, which is 1,980,000. So now we take that 1,980,000 rands, and we divide this again by 2,200,000 rands. Then after we do our calculations, 2,200,000 rands minus 1,980,000 rands. You can write this one then after you divide, but I'll just do it straight. 2,200,000 rands, and this gives us 0.1. Oh, don't forget to multiply by 100. I just had limited space there. Then this will give us 10%. This is the margin of safety percentage, or margin of safety ratio. What does the margin of safety percentage mean? This means, in simple terms, this means if the sales of the company decrease by 10%, it is still safe for the company because the company will not make a loss. Meaning the margin of safety is the safety position up to before the company can start making a loss. Now we know that our sales that the company, or the sale that the company wants to make in order to get the profit, it is the sales of 32,400. The owner said if the owner can sell these units, he will get the profit of or net income of 150,000. Now, if this is the sales that the company wants to make, then after we say, okay, if these sales decrease, let us say there's a decrease in these sales, decrease by let us say 5%. I don't want to use 5% all the times. Now let's assume that, okay, let's just calculate, not assume, and say 32,400. Multiply this by 5%. So this is 1,620, meaning our sales, if they decrease by, meaning minus 1,620, if our sales decrease by 1,620, which is 5%, that means the company will still be making profit because it is still below the margin of safety percentage, meaning the decrease of sales by 5%, meaning 1,620, is still below the 10% margin of safety. So margin of safety is the level at which sales can decrease by and the company still be making a profit. But immediately when the sales decrease by 10%, that will mean the company will be exactly at the break-even point. And immediately now, when the sales decrease by 11%, then the company now is already making a loss at 1%. Now, that is what the margin of safety means. And I hope I made myself very, 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 very clear on that. And it's very important to be able to explain your understanding of the margin of safety percentage. What does it mean? What is your understanding? Now, remember again, margin of safety can be margin of safety units. This 10% can be maybe 3,200 units. It could be margin of safety units. That means if sales decrease or even if sales decrease by 3,200 units, the company is still safe because it will be at the break-even point. That means if sales decrease by 200 units, the company is still making profit, but less than obviously before. And if the sales decrease by 500 units, the company is still making profit because the decrease in sales is still less than the margin of safety units. So it is a safe position for us to see by what percentage can sales decrease and the company is still making a profit. So it is very important to master that, more especially for the application of the business when we are there in the business, so that a loss does not become as a surprise, but you must have foreseen it based on the performance of the business in terms of sales. Then now we go to the last step of the question, or the last question, very short and straight to the point also. 3.4, we are required to calculate the new break-even point, not the old one, the new break-even point in units if the following changes are expected. Now, if the supplier of the raw material increases the price by 8%, assume that the selling price or the price or the cost price from our side of the raw material is increasing by a percentage of 8. Therefore, now 20 Rand multiply this by 1.08, it will give us 21 Rand 60 cents. That means we are expecting an increase in the material to 21 Rand 60 cents, meaning from 20 Rand by 1 Rand 60 to 21 Rand 60. That means if they wanted, they could have said increase by 1 Rand 60 cents. They could have said that, but they decided to say increase by an amount. Then the second one, assume that there is another change, and this other change, it says assume that the direct labor rate also increased by 10%. So now let's assume that our labor went up by 10%. What happens in this case? Therefore, now that means it will no longer be the 15 Rand, it will be 15 Rand multiply this by 10%, which 15 Rand multiply this by 1.1. I just want to get the final answer. It will be 16 Rand 50 cents. You could have also said 15 by 10%, meaning 0.1, you get 1 Rand 50, then plus 15 Rand, you get 16 Rand 50. A very long way for a student at the level of your caliber, honestly. Now, we have 10 Rand, but it doesn't matter which method of calculation you are using. Please don't be worried. Any method, as long as the answer is there. The manufacturing overhead, we don't know if is there any change or not. Let's go and listen to the question and see what does the question tell us about the manufacturing overheads. It is telling us that if variable selling and administration expenses increase to 6.90 Rand, so they are telling us about the variable selling and admin cost, not the manufacturing overheads that are variable. So now the meaning this 10 Rand remain the same, selling and admin increasing by or to 6.90 Rand. This is increasing to 6.90 Rand. That means this one remains in the old color, just to see the difference. This remains in the old color as black color. Then all others have changed except the selling price. That means the selling price still remains at old color 75 Rand. Then obviously the total of them will be at the different color because the net has changed. So now this becomes negative. Then after we say 21 Rand 60 cents plus 16 Rand 50 cents and plus 10 Rand and plus 6 Rand 90 cents. And this gives us 55 Rand as our variable cost. That means our contribution now will definitely be adjusted. Remember, our selling price remained the same and our cost went up. Therefore, now our contribution will definitely have to decrease from 25 to 20 Rand. So now this is our new contribution. And now that we have the new contribution, a new contribution being used in the calculation of the new break-even point. And take note once again, our fixed cost remained the same. There is nothing that was said about our fixed cost, meaning the fixed selling and admin still remains at 195,000 and fixed manufacturing overheads still remained at 465,000. Sometimes they can say fixed cost will increase by maybe 5%. It could be a percentage or an amount, and they can say fixed selling and admin will increase. They normally increase, they don't normally decrease, and they can also decrease at the same time, maybe decrease by 10%. Therefore now you'll have to make adjustment to your fixed cost. But in this case, there is no requirement to adjust our fixed cost. Therefore now we will be calculating now our new break-even point based on the adjustment of our variable cost according to what they have instructed us to do. So now our new contribution, it is at 20 rand. Then we are calculating the new break-even point 3.4. New break-even point in units. Then the new break-even point in units, it is fixed cost 660,000 rands. And now we can say plus the 150,000 because we know that the owner still wants to get the net income of 150,000. But in this case, once again, it is not clearly stated if must we calculate the break-even point units, new one, under the assumption that the owner still wants to get the net income, or do we not consider that? So at this point, honestly, this question was about to be very clear. It's kind of ambiguous now because you don't know if are you considering the fact that the owner wants to take a net income of 150,000. But I'll take the option where the owner still wants to take a net income of 150,000 rands. So now hence I'm saying plus 150,000 rands. If they did not require you to do this, please don't add it. But if they are quiet, I'll require that you take it into account. We divide by the new contribution, which is 20 rand that has been provided or calculated before. Then I will see how much will be. This is 810,000. We divide this by 20 rand in order for us to get to the new break-even point. So 810,000 divided by 20 rand. Then this gives us 40,500 units. And I hope you're very clear on this one because fixed cost, it is 610,000 plus 150,000 rands. Previously, this gave us 810,000. Divided by 20 rand, we get 40,800 units. Divide by 20, we get 40,500 units that must be sold in order for the owner to get a required return of 150,000. And at the same time, if we ignore or we become ignorant of the net profit, or the question requires us not to take into account the net profit, that will mean it will be 660,000 rands, and we divide this by 20. So now that means our new break-even point could have been 660,000 rands. Divide this by 20 rand, which therefore means it will be 33,000 units. So now depending to what you are required to do. But in such incident where the question is kind of ambiguous, preferable write this one and write this one, both of them, or you can highlight on top that you are under the assumption that the owner still wants to get the same net income. Therefore, now you can write this one. I normally do that when I was still a student. You say assume the net income. Assume net income of 150,000. Assume net income of 150,000. Assume net income of 150,000 rands. Or you can just write both of them, just to be in the safe position. Now, this is the end of this question. Very short, sweet, and straight to the point. Thank you very much, guys. You've been lovely audience. Watch other videos, go to other topic, prepare in advance. While I am recording, I recommend that practice while I'm busy doing the question, so that after the video is done, you are done also with the question. Use these videos as a means of practice and as the means of learning and understanding how to prepare your mind for the exam and how to tackle long questions, how to tackle complex questions while you are learning, while I'm teaching. At the same time, you can be doing what I'm teaching so that you are very fast in terms of the pace of studying in preparation of your upcoming exam. Thank you very much. You've been lovely audience. God be with you.